Good morning, everyone. Welcome to this month's Nico AM monthly update. For those of you who are familiar with the format, we're going to stick to the tried and true. So the first half hour we'll spend with a guest speaker from overseas. We'll introduce shortly, and then we'll finish with two sessions from our local speakers here in the New Zealand office, looking at the bond market and then the equity market. But our overseas guest speaker today is Iain Fulton, who is going to be known, I suspect, to many people on this call. Iain's been a regular presenter on this forum, and we always value his insights, his humour, and his wisdom when it comes to investing in the turbulent market that is global equities. Iain, obviously, you're based up in Edinburgh. We appreciate that it's now late at night there for you, so you're staying up, you're giving your time in the evening. We are really appreciative of it, and we look forward to hearing what you've got to say. And so for the next 25-30 minutes, we're in your hands. Thank you very much.
Thank you, George. While the guys bring up the slides, I'll just begin. Essentially, we invest in what's called future quality. So on this first slide that we're about to bring up, these are companies which really have better growth and better return on capital prospects that we think in the marketplace. And what you get, the reason for that is that they have better quality characteristics and they have that ability to compound up your capital. And they also, incidentally, have better ESG scores into the bargain. So I'll talk a little bit about these three factors, and then we'll get on to what we're doing in the portfolio and how we're positioning for the current marketplace. So just turning to slide 3, I think that would be great. So why do we look for improving growth and improving returns on capital? So this slide has, pretty simplistically, it's based on a study that's done by Credit Suisse going back 70 years. And what they did was they looked at the coming 5 years. If you had perfect foresight and you knew what was going to happen, where should you invest? So the companies with the highest growth rates, which is on the left-hand side, if they can improve their return on capital, which is the top scale, so if you can grow really quickly and improve your profitability, these are the companies that outperform, and they outperform significantly over that 5-year period. If you grow very quickly and you don't improve your profitability and don't improve your return on capital, you might do okay, but you're quite possibly still going to underperform. And you can even shrink. You can have low growth in that bottom right-hand corner, but as long as you improve your return on capital, so businesses that are restructuring or getting into new areas that are more profitable, they can actually do okay as well. But the perfect combination is to find the companies that are growing really nicely, but also improving the return on capital and improving profitability. And that's what we think is absolutely key to long-term outperformance over time. So that's what we're trying to do. And it's based on this kind of study and this empirical evidence that looks back over the actual outcomes historically and how they panned out. So just turning on to the next slide, that's why we look for high returns and improving growth. Well, how do we do it? Well, again, many of you will have seen this before. It's all about what we call future quality. It's that strong franchise, management teams that are incentivized to allocate capital to find growth and to improve those returns over time, done with strong balance sheets and at sensible valuations. Now, this valuation thing is the bit we're going to dig into a little bit, because I'm guessing that's what's on people's minds. I think when we spoke the last time, we kind of flagged that there was a huge dispersion in markets at the end of last year between the highest valuation and the cheaper stocks in the market. And since then, as vaccines have rolled out and economies are opening up, we've seen that valuation gap begin to narrow. So are we nearly there yet? Well, we're going to have a look and try and find out. The next slide on page 5, I kind of hinted that into the bargain with these better quality businesses, you tend to find that they have better ESG characteristics as well. And we found this over time with our portfolio, that we tend to have better ESG scores than the benchmark. And we also have a far lower carbon footprint than the benchmark into the bargain. And this all comes from the quality element of the businesses that we invest in and earning the right to earn these good returns on capital. As we'll get to in a little minute, governments and regulators are much more present in our lives today than they probably have been at any point in our careers, certainly, and for many people in living memory. And as those regulators and governments become more powerful and are bigger agents within the industries and economies that our companies operate in, they need to operate to the kind of highest standards of corporate behaviour. And if they don't, then they're going to find that those returns on capital are going to be regulated away, or additional costs are going to be borne by that business. So these ESG metrics have got real financial materiality, and that's why we pay very close attention to that. And it's a nice side benefit of that quality in the portfolio that we have these good scores across the portfolio. So turning on to the next slide, and this puts all that in a bit of a graph, lots of lines going on here, but again, you know, around about 20% of the companies in the market can make it through to future quality. So that's quite a reasonable number, but you know, 4 out of 5 businesses are going to maybe start as very good, but they're going to deteriorate, they're going to become average over that 5-year time frame. You know, most kind of bumble along doing the same sort of thing, and there are some that go from, you know, not so great to okay, and you know, they can be reasonable performers in places, but as we said, it's that pathway of improving improving returns on capital with good growth into the bargain that we're really looking for, but it's quite scarce. Now, the next slide puts this in the kind of current COVID perspective. I mean, last year we clearly saw a huge dislocation with, you know, many companies seeing demand rapidly accelerated by the circumstances that we were all living under at that time. You know, less so clearly in New Zealand, but around the world, absolutely impacted by that. So that pull forward of demand for certain sectors and certain industries was very, very real. So cloud infrastructure, for example, gaming companies, home delivery for takeaways and food, COVID-related healthcare clearly saw a huge pull forward of demand. And that, on the flip side of all that, we saw these COVID cyclical losers, which really revolved around routine healthcare procedures. So, you know, that standard treatment that you would be going in for, or elective surgeries, for example, which have all been cancelled. But, you know, they are going to recover. Obviously, travel would come into that as well. That may have a slightly longer lead time on it. But many in the manufacturing sector, we've seen lots of disruption in supply chains, which is causing some of the inflationary pressure that we're seeing today. And then that away from home consumption, the service industry in retail, across restaurants, the food service sector, you know, really severely impacted. So we've now got that cyclical bounce, which is coming and is absolutely being anticipated in markets today. The next part that kind of adds to that, so that's fundamentally what's going on. We've had a pull forward, and a cyclical recovery is now happening for these COVID losers, if you like. But the other complicating factor on the next slide is really all about valuation and what central banks have been doing. So central banks, as we know, in the face of the pandemic, have made liquidity abundantly available, and that compressed bond yields really significantly. At the same time as we saw these kind of big winners in the COVID kind of stay-at-home economy, and gaming, and in many parts of the technology sector. So we had this collapse in bond yields, an acceleration in demand, and a separation of performance in the underlying market. And what that actually led to was a huge expansion in valuations. And that expansion in valuations has begun to correct as we're beginning to see bond yields rise, as some of those inflationary pressures are beginning to come through. So again, are we nearly there yet? Is this phase, you know, almost unwound, or where are we in this journey? Well, hopefully the next slide gives us a little bit of a picture on that. So slide 9 here looks, and I think we've spoken about this before, looks at the since 1952, the highest growth companies in the US market. So the top 20% of fastest growing businesses, doesn't really matter how profitable they are at that point, just the businesses that are growing the fastest at that point in time, throughout that kind of 70-year period now. And what we can see there is that, in the middle of last year, I think just before we spoke in November, we had a dramatic expansion in valuations last year above the kind of dot-com bubble level. And now we've seen that retracement, but, we're not really entirely there yet. So we're halfway back, but we're still at very elevated levels relative to other points in history. So if we believe that the cyclical recovery can continue and that some of these disruptions in supply chains will also prove to be a little bit longer lived than we might expect, then that upward pressure on bond yields is likely to continue. The cyclical improvement in some of the COVID losing areas of the economy are likely to carry on, and we could see this valuation compression really continue to move back to more normal levels. So a kind of meeting in the middle of valuation is probably what we're going to see, and that's what we've been trying to bring to bear in the portfolio. So we've brought that together on the next slide, on slide 10. So the changes that we've made since we last spoke in the latter part of last year has really, again, all been driven by that valuation discipline. Some of the COVID winners that we spoke about, Nintendo in particular, which obviously had a huge pull forward in demand of a very good Switch console product and excellent software, which has done incredibly well. But there's a lack of impetus behind the new product cycles that are coming to kind of fill that gap in demand, if you like, that needs to come next. So we've sold our position in Nintendo. Some reductions in some companies that had done extremely well last year, like LHC Group, who provide at-home nursing care. And that's a business that we think has fantastic long-term demand profile, but the valuation had expanded quite significantly during that pull forward in demand last year. So we took the opportunity to actually switch into a peer in Encompass Health, who have an at-home nursing business also, but they also run rehab facilities for people coming out of hospital, and who are undergoing, have undergone operations and are then, recuperating in these rehabilitation facilities. And we think Encompass have a fantastic, medium to long-term demand profile, and the valuation was a little bit better than LHC because of that operational gearing in those facilities, which have been underutilized during the COVID period. Other changes that we made, again, one of the strange kind of side effects of the pandemic in the retail sector was that we were anticipating there would be an excess of inventory, because demand had collapsed and there was surplus stock, in many stores which were closed. And we expected that companies like TJX would be able to buy that inventory very cheaply and sell it on at discount prices to their customers who doesn't love shopping in TK Maxx. But really the scarcity of that inventory has been quite remarkable. The success of brands to ship product online and to move very quickly to liquidate their inventory and overstock positions has actually been incredibly successful, and that's left a bit of a more challenging buying environment for companies like TJX. So it's a business model it doesn't fare quite as well in an inflationary environment. So we exited that and have actually replaced it with a company called Tractor Supply, who are a kind of rural lifestyle retailer in the US, and who we think will have a very good long-term acceleration and growth. And they're reinvesting the windfall that they've had from COVID to actually make the business more efficient and more profitable longer term. So we're very encouraged by that. But that's some of the changes that we've been making, reducing some of those COVID winners, increasing areas where the valuations have been a little bit more attractive, and that's really been driving what we've been doing at the stock level. Just moving on to the next slide, you can see that what this has meant is that the active weight for our defensive companies within the portfolio has actually gone up. So healthcare, consumer staples, utilities, we are becoming a little bit more defensive as time is going on, and the valuations in those areas are looking very attractive. And that's come at the cost, if you like, of our weighting and exposure in the technology sector, and also in the communication services area as well. Again, primarily based on valuation. These are great businesses, but we think the premium that's being paid for some of the growth and returns that are being accessed is a little bit high, and we're finding some better opportunities on the other side. So again, we've backed this up in the next slide. If we can just move on to that. And again, this is showing the aggregate valuation for the portfolio. Again, it's always difficult to convey this in a simple metrics, but we've tried to convey this over the long term. You know, if you're below the zero line, this is a style tilt. If you're below that line, you're paying a little bit of a premium for the stocks that you hold. So our free cash flow yield is slightly lower than the market. But again, that's because we've got higher growth rates and they're more profitable, often with better balance sheets, and that premium has usually been worth paying. But you can see that at the end of 2019, and as we got into the start of the pandemic, the valuation premium that we were paying had really gotten pretty sizable, and 2 standard deviations kind of high relative to the norm. So it's been a very conscious decision to try to move that valuation gap back in towards a more neutral stance, you know, still a slight premium. And we've been able to do that without sacrificing the growth characteristics or the quality within the portfolio. So we're very encouraged that we've been able to do that. And as I mentioned in some of the transactions, we've done that through picking up some additional ideas in the healthcare sector, but also actually in some industrial areas, companies like John Deere, who have got a fantastic new product cycle. Farmers in general are in very good financial health right now, and we think there's a long replacement demand that's coming through with a great technologically advanced product now, with much better data being deployed by farmers to improve crop yields and to increase the efficiency of what they're doing. So there are very interesting opportunities, we think, in some traditional sectors that are still going to see some very high rates of innovation and change going forward. So rolling that on, just one more slide. Where are we today? Well, our biggest exposure within the portfolio is still in healthcare. We're absolutely convinced of the long-term need to reduce the cost of healthcare delivery. As we mentioned, as elective surgeries, and it's not non-essential, but less critical healthcare procedures recover, we think companies like LivaNova have a very strong outlook, as well as what LivaNova bring to the table in terms of mental health and the indications they have for some of their treatments for patients with depression. We think, unfortunately, there's a very long runway of demand for those types of products, and LivaNova stand in a very strong position to deliver against that. So, you know, the portfolio is still skewed towards healthcare. We still have a good weighting in consumer discretionary. Companies like HelloFresh, I know, you know, meal kit solutions are very popular in New Zealand, and we're actually very encouraged by the experience that's been had within New Zealand, as you know, the economy is obviously much more advanced in terms of being back to normal, and yet the penetration of meal kit solutions and the order frequency and customer growth is still pretty strong. And you know, we're very encouraged that that might be a lead indicator for other markets, where the market still believes that HelloFresh will see a decline in customer numbers this year and the order rates will fall. We don't think that's the case. So we think it's a COVID winner that can actually keep on winning, and that's not entirely discounted in today's share price. So, you know, just concluding perhaps with, you know, our observations on the market and what our outlook is on the next slide. You know, I would also add on that previous one, we're clearly, you know, underweight in technology and communication services, really for the reasons that I just mentioned. But to conclude with our outlook and comments here, we're very clearly in a post-COVID cyclical recovery, but the market is discounting a lot of that demand, quite quickly, and valuations for those recovery stocks are moving up, pretty rapidly. So the direction of relative earnings and the ability to deliver on, some quite high expectations now are becoming, very, very important. So we're trying to be very selective in the cyclical exposures that we might take. So companies like John Deere or businesses like Schneider, where we've got pretty long investment cycles, we think, as governments move to kind of energy transition infrastructure, these spending patterns are going to be very long-lived. And we think there's a good runway there, rather than necessarily trying to play a rapid recovery in restaurant companies and reopening, which has already in many cases been discounted in some quite high valuations. So we're looking for long-term demand patterns that are underpinned by some of these problems that we face in society today. And we think those types of long investment cycles are where we should play that. So that plays into the fiscal policy that we're seeing in the US. And we think that will remain a driver of allocations within equities, to be perfectly frank. What about this inflation bump that we've seen? How sustainable will that be? Will we continue to see these valuation dispersion, narrow in to meet in the middle? We think that probably runs further. But I think beyond this COVID cyclical recovery, what do economies look like at that point? At the end of the day, we have an awful lot of debt, which has been racked up by governments, and we need to deal with that. Now, inflation would be great if that can be generated to help with that debt service cost and that burden. But we've still got the demographic challenges that we've always had, and we've still got productivity gains that can be made. So it's going to be interesting to see how sticky the current cyclical inflation that we're seeing is going to be, and whether this is just a kind of transition phase back to a level of normality, and we will have that kind of disinflationary environment that we've all experienced over the last kind of 20 years or so, to be perfectly honest. So that's probably our central case, is that longer term growth is probably going to be fairly subdued, and we need to find these businesses that have long-term investment cycles behind them, and they can make their own weather and have these, gaining market shares with improving returns on capital and decent growth. And as long as we don't overpay from a valuation perspective, then we think that's probably the best way to navigate through, what is a fairly provocative setup within markets today.
Excellent. Look, thanks, Ian. That's a great summary and overview of your process and how you're thinking and navigating these interesting times. A couple of questions that have come through relate to, obviously, you are a stock picker primarily. It's a bottom-up process. How much of the overweights, particularly to countries, we've got the USA and the UK, is a function of just the outcome of the companies that you like, and how much of that is driven by the preference to be in those particular regions in the current environment?
Yeah, thanks, George. I think it's a good question. We always want to make sure that the stock-specific risk is the biggest contributor to the overall risk that we're taking in the portfolio. So, a bit like going down to the casino, we don't want to just bet on red and hope that things fall that way. So just, betting on one sector or one industry or one country, you might get it right, it might be a home run, but it might also not work out. So we need a good level of diversification, and we want that country risk to be not the biggest thing in the portfolio. It's the stock specific risk that we're trying to isolate and find these great businesses that have got these improving returns on capital and good growth rates. Now, it so happens that we're finding a little bit more of that in the US. The UK component is actually partly driven by that valuation element as well. So the UK has not had its problems to seek, let's put it that way, over the last few years, and that has clearly impacted the discount rates that are applied to UK equities. But there are many global companies which are fantastic positions in very good industries, Compass would be a good example, and it has been impacted from a negative point of view in terms of the cyclicality of COVID and workplaces being closed, and around about 60% of their business is still only just beginning to reopen. So these businesses have got great prospects ahead. We think very good from a recovery point of view, but they're also on very good valuations, partly because of some of that top-down stuff that's been going on in the UK. So it's very much driven from the bottom up, but that top-down element can give you an additional opportunity, which we do try and take, but we don't want it to be the biggest contributor to risk in the portfolio. Hopefully that gives a flavour of what we're trying to do.
And a question, I think you got this about a year ago, which was lockdowns and how does that impact your ability to research companies? I think you said in your intro, 450 days later. How are you finding the continuing to do the work remotely, and how much are you looking forward to actually being able to meet companies in person and see management face to face again?
Yeah, I think, like you said, 450 days of working at home. I don't know, 1,200 plus Zoom calls, probably averaging, three plus a day, something like that. 1,700 stairs in the fridge, I would say that. But apart from that, we've been able to get great access to companies, so that has not been a problem. And if anything, we've been able to do more in terms of speaking to management teams, because they've not been on the road. They've been based in their location, so it's been easier. They've had more time to speak to investors outside of closed periods, obviously. So our access has been very good, but Zoom has its limitations. But I think the biggest challenge as a team, and we invest as a team of 7 investors, the biggest challenge is from a creative point of view, and just getting those conversations and mentoring the younger people on the team. That's much more difficult to do over Zoom than it is in person. So we can't wait to get back to the office, that's for sure. We're fortunate that our performance has held up very well. We think we're navigating this value rotation, given our style towards better quality and better growth. We think we're navigating that fairly well right now. But we're very keen to get everyone back in the office and continue that development of new ideas and that creativity that you can only get from sitting together and working as a group, and we do miss that.
Yeah, well, look, we appreciate you joining us on our Zoom calls, but we're really, really keen to have you back in New Zealand once our borders allow for that, and you can come back in again. So hopefully in the not too distant future, we'll have you down under, and we'll get you in front of people in person again. But for now, Iain, thanks very much for your time. Have a good, well-earned sleep, and we'll catch up with you again before too long.
Thanks, George, and I'm sure it goes for my family that they're probably desperate for me to come to New Zealand as well after 450 days in the house. So honestly, thanks everyone.
Cheers, Iain. See you.
Thanks.
And so, look, we move from one Iain to another Iain. Iain Bellew, as I think all of you on this call will know, is part of our fixed income team here in Auckland. Iain's been managing the bond portfolios and involved in the debt markets and the macro position in New Zealand now for well over 20 years, and his insights are always worth listening to. So, Iain, if you've got about 15 minutes just to take us through what you're seeing going on, inflation, interest rates, portfolio positioning.
Good morning and happy Friday, everyone. I'd like to start off with where we see the prospects for bond fund returns going forward. So as a starting point, I think it's worthwhile looking at where we've come from and where we could have been. So I think that we're certainly in a lot better position now with interest rates higher than we would have been if we got into a negative cash rate regime. If you look back to September, October, a 10-year bond was around 40 basis points. So if we had gone into a negative cash rate type scenario, then arguably we'd be looking at very low returns out of bonds for quite some time. And the government would have had a lot more difficulty funding itself, given that New Zealand bonds wouldn't have looked very attractive to offshore borrowers. Where we sit today, of course, is we've had a substantial rise higher in interest rates, predominantly from the 5-year out to the 20-year bond. The long end is where the rise in rates has already occurred. So our 10-year bond has risen by approximately 1.5% today. That 10-year bond is about 1.9%. The 5 years a shade over 1%, and the long bonds, the 20-year bond is about 2.75%. So I do recognise, there has been a lot of concern over rising interest rates, but I think to a large extent the bulk of that has already occurred, particularly in the long end. It's certainly not unusual for bond markets to run ahead of or anticipate what is actually going to happen in the real economy. And so I think a lot of the good news effectively has already been priced in around the reflation trade story. It's certainly not unusual that over the course of the year, New Zealand bonds will trade within 0.5% to 1% range, and I think that's where we are for the for the near term going forward. I think bonds are largely range bound. If you look at what central banks around the world are saying, they're saying that they're prepared to basically be patient, accommodative. The world still needs stimulus. They do expect there's going to be still some considerable disruption through supply chain constraints, etc., which will no doubt be inflationary. But what the market's most interested in is how long this transitory phase is going to be, and when we get through the other side of it, where should interest rate settings indeed be? So the concerns for central banks would be if those inflation expectations become ingrained, it flows through to higher wages and salaries, and then that flows through to second round impacts on the economy. At this stage, we still think that's probably unlikely to occur. I do acknowledge that we've already had a rebound, and to some degree New Zealand is effectively running ahead of the cycle, given that the time period between, I guess, the recession and the recovery has been a very V-shape and very much in a contracted period to previous downturns. It is unusual in that regard, but I think it makes sense for central banks to be patient, probably for the next 6 months to 18 months to see what the actual outcome is when the noise or the dust has settled. We've had the Reserve Bank out just this week, and as I said, we think that New Zealand is maybe, from a cycle perspective, perhaps a little bit ahead of the rest of the world. There was some surprise, I guess, but not necessarily unwarranted, that the Reserve Bank has actually forecast at some stage they expect on the projections to be raising interest rates. So they've reintroduced the dot plot for the official cash rate, and that they do caution that these are projections, not forecasts, based on their best understanding of the economy and the world as they see it at the moment. So the Reserve Bank has the cash rate increasing by 25 basis points to 0.5% mid next year, and then in 2024 they have the cash rate approximately 1.5% higher, around about 1.75. But of course, there's a lot of water to go under the bridge until we see what the actual outcome will be. So what we're talking about there effectively is influences on the short end of the yield curve. So we've already said that our expectations are that a lot of the rise in rates has already occurred in the long end of the yield curve, 5 years, 10 years, 20 years. So probably what we're more concerned about now is the path forward for those short-term interest rates, i.e., 1 year up to four years. So as a bond manager, there's steps we can take to mitigate a potential rise in interest rates. We can underweight the fund's investment in certain parts of the yield curve, so yield curve positioning. We can hold less bonds in that 3, 4, 5 year bucket. And when we think that we are higher in the range in terms of interest rates, we can buy 7, 10-year bonds. And if we thought there was an overshoot in the back end, then we could more barbell the portfolio, which is where we'd have a holding in short-term bonds, 1, 2, 3 year bonds, and maybe a higher holding in bonds 10 through to 20 years if we thought that there'd been overshoot in interest rates and that offered good value going forward. So that's probably something that we're waiting for. Currently, we are positioned around index duration. The reason why we're not short is because, as I said, New Zealand interest rates have had a large move higher, and currently we're towards the top of that range. So the New Zealand 10-year is currently 1.9%, and that's about as high as it's been this year. So on an incremental basis, we probably see those longer-term rates offering value at the moment. If we saw a fall in interest rates by 20 to 30 basis points, we probably would look at shortening the duration of the portfolio, so having less interest rate risk relative to benchmark. And conversely, if interest rates rose, 20 basis points, we probably would incrementally buy some more longer bonds. Also, something important to point out is from an offshore perspective, New Zealand has become a lot cheaper, so a lot better value. If you went back about 3 weeks, New Zealand 10-year bonds were trading around about 15 basis points lower than the equivalent 10-year bond in Australia. So today we're trading about 25 basis points higher than Australia and the US. So there has been some re-emergence in offshore interest in the New Zealand bond market, which we see as supportive. So when we're looking at where to from interest rates, starting point is always looking at things we have the highest conviction or the things we think are most likely to actually happen. So the things that we know is that we're in a rebound situation. We've already largely had a recovery, but the rest of the world, and predominantly the US, is still to really have their recovery. So New Zealand had an increase in their savings rate while we're locked down, and also a build up in spending that just couldn't occur. That's happened to a much larger degree in the US because they've been shut for longer, and also the rise in their savings rate has been a multiple of the rise in the New Zealand savings rate. So certainly we expect the behaviour from the US consumer to be a lot stronger in rebound than what it was locally. So that's certainly one risk. If the US recovery is a lot stronger, that could spill out to the rest of the world, and we'll see faster economic activity and most likely higher inflation here in New Zealand. But when you look at inflation as well, it's also important to look at where we've come from. So if I use the US as an example, where we think inflation is perhaps going to be higher than New Zealand, if you go back a year, their inflation rate was running at just over 0, so 0.3%. The reading for the last 12 months was 4%. So if you step back and average those out, then the average is 2%. So it's very much what central banks are talking about, is we've had a large undershoot in inflation. So we're prepared to tolerate a period of an overshoot in inflation, but they will be keeping a close eye on that. Also, we've had the budget out just a week before, so there wasn't really much of a market reaction to that. But probably the 2 points that we did take from that are the increase in welfare payments. It is likely that a lot of those monies will actually be spent and flow through to the economy, so that's going to be good for economic activity. And also the supply of governments was higher than expected, particularly in the near term. So by mid-June, we will have a syndication of a new government bond, a 2032 bond. Typically, before you get new issuance of government bond, yields rise as the market looks to cheapen up effectively the new issuance. And then by December this year, we're going to have the issuance of a 30-year government bond, a long government bond, which does make sense that the government is extending their borrowing profile when interest rates are very low. And then next year, there is another syndication as well. So in the near term, there's probably going to be more government bond issuance than we expected, but once you get up to sort of years 2, 3, 4, there's probably going to be less issuance. And it's unlikely also that a lot of that money will be able to be spent. At the moment, it's targeted for infrastructure spend, I guess in loose terms, but they don't necessarily have shovel-ready projects to spend that money on. So what's likely to happen is that the government will actually have a build-up in cash, which will be a buffer if they need to provide more stimulus to the economy, or if there is more projects that they can invest in. So that's going to be supportive of economic activity in New Zealand. I'd just like to cover a few points that the Reserve Bank Governor made as well. Regarding interest rates, he was mainly talking to the mortgage market. He said, really you should stand back and, we've had a rise in interest rates, but when you look back, interest rates are still very low. We're still quite a long way from what we talk about as being a neutral rate. And that's why I think the market shouldn't necessarily be spooked about a rise in rates, because what we're really talking about is the cash rate returning from a very, very low and unusual level of 25 basis points back to a more normal level. And what that does is it gives the central banks some ammunition to lower rates if there are bad times ahead. So they want to move the cash rates back to a more normal level, and that's totally unexpected. I guess what we're toing and throwing about is a time frame of over what period that movement will occur. It looks at this stage that the rest of the world central banks are probably going to be more accommodative, but the actual outcome will probably be somewhere in the middle. We might be slower to raise interest rates, and they might have to change their rhetoric sooner. Another thing the bond market has been focusing on, more so offshore, is the withdrawal of or reduction in government buying of bonds, so QE, i.e. tapering. To a large extent, that's already happened in New Zealand. At the worst of times, when we're issuing a large amount of government bonds, the Reserve Bank was buying up to 1.9 billion of bonds a week. That's already been tapered back to about 350 million in New Zealand, and that has been largely uncommented on. Maybe one of the underlying reasons why New Zealand has cheapened up to offshore, but we've managed to accomplish that in a relatively smooth degree without any larger impact on the market. So the buying pace of 350 million is around about equivalent to the issuance of government bonds at the moment. Also, another thing I'd like to comment on is credit. Credit is somewhere probably where we have a higher conviction that that will continue to be a reliable value add to the portfolios. New Zealand market is still structurally short. Probably the strongest driver of any market, of course, is supply and demand, and there just doesn't seem to be the new issuance to meet the maturities in the New Zealand bond market, particularly in bank names. There has been a little bit of a shift in, I guess, the demand dynamics around what bonds have been issued into the New Zealand market. Of course, if the sovereign upgrade of New Zealand becoming AAA, LGFA bonds or housing bonds are now also AAA, which is the highest rating and equivalent, of course, to the supranationals that issue in New Zealand. From a credit perspective, we probably prefer higher rated credits. And the reason why I say that is that the bank names have already gradually widened in credit margin. So if you look at Australia, a 5-year bank, in terms of credit margins, around about 45 basis points. In New Zealand, we're closer to 60 basis points. So we think there's already been some normalisation in credit margins in New Zealand away from being very expensive to around about fair values. So it's probably doesn't do any bond portfolios any harm if you get a gradual widening in credit margins. In fact, it can be a good thing over time, because you get the benefits of carry and roll as the bonds move from a four-year bond to a three-year bond, and then you get your credit margins issued at wider levels can actually be of advantage to a bond portfolio. Of course, that depends on the how fast that widening credit margins occurs. But we don't really expect credit margins to narrow a lot from here, and we don't expect them to widen a lot from here. So I'll just pause for a minute and see if George has any questions.
Many thanks, Iain. Well, that's a really helpful summary, and there are a couple of areas that we could chat about. But I think, in the interest of time, and to move on to the next thing, we'll thank you for that input, and we'll follow up with additional questions outside of this forum. So many thanks, Iain. Appreciate your insights. Very helpful as always.
Okay, thank you. You're welcome.
And just for us, the team, do a little bit of musical chairs. I'll introduce you all to the final speaker for this morning. He's presented to us before on this forum. Michael De Cesare is one of the portfolio managers in our New Zealand equity team. He has specific responsibility for the New Zealand SRI, the Socially Responsible Investment Fund, but obviously also he has analytical responsibilities for a number of other sectors as well. So, Michael, welcome to this session. Thank you for your time this morning. And the last 15 minutes, we're in your hands for a roundup of interesting insights in the New Zealand equity markets. Thanks.
Thank you, George. Yeah, it's great to share some information with you again today. This morning, I'm going to be talking about the NZX50 performance month to date, but also year to date, and specifically in the context of the performance of comparable developed market indices. So if we start month to date, the NZX50 is going to deliver a negative return for the month, barring something quite special today and Monday. It's currently 5% down. The main topic of interest in May has been a relatively small reporting season dominated by property funds, real estate investment trusts, who have largely delivered in line with expectations and no big surprises. The group who report do include two heavyweights, one of those being Mainfreight. Mainfreight operate a global logistics supply chain and have been a beneficiary of COVID implications, and have done a very good job at managing their business through difficult and unprecedented challenges. So they managed to grow their earnings by double digits and 10% ahead of market expectations. So that was well received. Yesterday, Fisher & Paykel Healthcare, who could arguably have had the most direct exposure to the COVID response or solution in New Zealand, they delivered an outstanding result, enormous growth, but just one of those nuances of equity markets when expectations are a tiny bit ahead. Even if you do deliver something quite magnificent, you can still actually have a negative reaction. So Fisher & Paykel finished down 5%, I think, on the day yesterday, having reached down 12% at its lowest point. But once into the details, analysts quickly gained comfort on some of the reasons why they didn't do quite as amazing job as they thought they were going to do. If we move on to year-to-date performance, if you don't mind, what I've presented here is a number of bar charts. First of all, the Miski World Index to provide a fair aggregated representation, before just a number of key developed market peers. What we can observe from that is clearly strong equity performance across the peer group, with New Zealand with New Zealand being the one on the far right, and clearly an outlier, having delivered a negative return year to date. So that's an interesting observation in itself. And I'm just going to take some time to talk to several perspectives which may or may not provide some insight into this divergence, help us understand somewhat, and even get a sense for what the future might hold. So we'll move on and try and attempt that now. So as a reminder, the RBNZ came out this week, and updated the market and stakeholders that in general, most things are going much better than would have been expected 3-6 months ago. The RBNZ commented on GDP, employment, dairy prices, soaring business confidence, and still steady housing, although we know there's some policies at work now. So with a firm macroeconomic backdrop, we then cast our attention to the listed equity market here. So the table I present, with the main part being the centre and centre-left part, it's the NZX50 estimated earnings growth, EBITDA, earnings before interest, tax, depreciation, and amortization. So that shows the expected growth rate that was believed to be ahead of us for 21, 22, 23, and annualized in the first column, as at December 20 at the end of last year, with those numbers presented there. And then the point being, if you then look at the adjacent column, which is current, you can see the positive revision in those earnings expectations that's occurred in the several months since the start of this year. So there's clearly been a very strong positive and upward revision in earnings expectations for New Zealand companies. So on one hand, we've got a stronger macroeconomic framework. On the other hand, we've got companies outperforming expectations and delivering some serious earnings growth. But still, we find year to date, our equity market is posting negative returns and also underperforming the returns of our rivals, of our peer group. So this slide here is one that you probably would have seen before. It displays a group of equity stocks, and we just call them dividend yield stocks. So it presents a dividend yield of those, which will be in the red line on the chart on the left-hand side. We can see how, given most likely strong rallies in those share prices, the dividend yield on offer has compressed over time from just over 10 years ago to now. And adjacent to that, we can see the black line, which is a reference to the 10-year swap rate yield you can earn in the fixed income market. So whilst the spread has been maintained quite well over recent years, if we do just look at the most recent data points here, we can see a pretty stellar lift in the swap rate there, and the point being the extent that there have been investors who traditionally have affection for bonds and bond asset classes, but whose low returns have found them disenchanted and indeed seeking higher returns, moving up the risk spectrum and dabbling in equities. To that extent, there'll be a point, maybe now or maybe soon, where the alternative asset class in which they fled makes a recovery, and its relative attractiveness of the equity market will decline as that happens. So I'm not suggesting that is right now, but it is worth a consideration, given the defensive yield has been compressed so much over time. And just the chart on the right shows the spread between the two, having risen steadily since 2013. You see around 2020, it peaks before a pretty sharp decline, and who knows if that goes much further. Bond experts do remind me that while some people consider equities as an expensive asset class, still by no means compared to bonds. Apparently, we're reminded equities are still cheap compared to bonds. So maybe this perspective has some limited validity, but I do believe there's something interesting there to share with you. Moving on to a slightly different perspective, I thought I'd share with you international ownership of the NZX 50 market. So if we call the start on the far left 2010, say post-GFC area phase. We've seen a pretty steady and healthy rise in foreign ownership of our domestic equity market, reaching 43%, a peak in March 20. 42% peak in March 20. However, it did actually come down from there and end the calendar year 20 at 37%. So having continued to rally and grow stronger into March, from March to December, the trend was down. We're very cautious not to look at these very short-term trends and try to make grand general representative conclusions that investor sentiment towards allocation to New Zealand may be changing, or could be more attractive or less attractive. Rather, it's just we're recognizing the data points have been negative, and I did a little bit of digging with some help of a counterpart at Forsyth Barr, who works with Stats New Zealand to produce these proprietary data points, and were happy for me to share with you guys. The data points we see here is until the end of December. We have received the Australian portion, and the Australian portion has continued to decline through to April. That's not surprising in a way when you remember the clean tech ETF, which was buying up Contact and Meridian in particular, peaked in December, January before falling monumentally into this part of the year, as has the A2 milk share price, well held in Australia and well held by internationals, also falling quite substantially. So just with those two factors alone, that would explain an ongoing decline in foreign ownership in the New Zealand market year to date. And how long that persists in the past, the money must be recycled into the next good ideas in New Zealand. It's not necessarily lost forever, but it's just a trend that I wanted to share with you in this instance there. If we move to the next slide, I found this, I put these two together just to just to highlight the proposition of New Zealand, remembering it's seen as a safe, defensive, reliable country, a liberal democracy, stable economic system, one that in theory has large companies operating in oligopolistic industry structures, and thus should be able to produce semi-reliable free cash flows and pay dividends in comparison to bigger and more dynamic markets. So New Zealand does have that bond proxy type, those bond proxy type features. However, probably the main feature against the alongside the low risk conclusion will be the actual yield you get. You can't actually get away from that part. So when you look over 10 years ago at the start of the time series on the left chart, it shows forward cash dividend yield of New Zealand and a number of its peer group. New Zealand being the red line, and Aussie was slightly higher back in 2008 for many reasons. And one of them will be a substantial outperformance of the New Zealand equity market over its peers over time, with DPS not managing to follow, will have had the effect of pushing down the dividend yield you can earn on the index. As a result of that being one of the main drivers, if you look just to the end of the chart section here, you can see actually New Zealand's just slipped, into and among the pack from a defensive dividend yield point of view. So without taking into consideration all the good things that I just described about the industry structures and so forth, they could at least, your marginal, your incremental investor looking for dividend yield could be looking at some of these other alternative markets as an opportunity, and one with less liquidity risks than might be faced in New Zealand. And then on the right hand side is just showing the growth profile for several members of the peer group, with the purple bars being the 3-year annualized, and New Zealand has a admirable 6.7% CAGR, but just noting that some of the other countries have pretty robust earnings growth on offer as well. So for investors who want to have the defensive yield, the bond proxy, maybe there are more games in town than there used to be compared to Aussie and Kiwi there, compared to the pack. And for those looking for us to benefit from a strong V-shaped recovery from the global reopening, then there are potentially other places to look for that just at this point. I'll try to speed up a bit just for the interest of time. This is just some really interesting work I found from Citigroup in New York. What they did was look at the GIC sector beta to rising rates, and they're using nominal rates as a proxy for inflation. Noting that as we've moved into this year, there's lots of uncertainty at the end of last year, but really market leadership from a thematic point of view has been the stimulus, the outperformance of the COVID vaccinations, the vaccine efficacy, and therefore the reopening trade and the reflation trade. So against a US study, mind you, has revealed the GIC sectors most sensitive, like positively to inflation and negatively to inflation. So if we look, so what I did then was to see whether that model is actually valid in real life year to date. So year to date, this top half are the high beta sectors, highly sensitive to inflation rising. And you can see pretty decent returns across those key sectors across a number of representative markets. And just for simplicity, I just made a simple average of the 4 different markets in each sector, and then the same for the low beta, just to get an impression. And optically, you can see that model, optically at least, does show like there could be some causation effect involved there. Once accepting that this could be a valid driver, we then have to look at our markets and decide who are going to be the winners of this and who will be the losers, or who will be in the middle. Unfortunately, at this point, New Zealand's exposure based on the sectors to the high beta, which I just conclude here, is 29%, and to the low beta is 71%, versus Australia, for example, who enjoys close to 70% exposure to the high beta sectors, UK 70%, and the US is pretty special. It's a pretty special case all in all. I wouldn't feel good if I didn't have my usual disclaimer that these global comparisons are great and I enjoy them and I enjoy sharing them with you, but I always need to remind us that we're operating in somewhat of a peculiar market. 50 stocks, 50 good companies. The relative size and the concentration makes life difficult. As I said, Fisher and Paykel had a bad day yesterday and it's 16% of the index. So that's going to have a disproportional impact on the return. So with that in mind, I found out what the equally weighted equity market return for New Zealand would be if simply every stock was held at a equal weight. And instead of being down 7 or 8% year to date, the market would be up 0.5%. So at least it'd be in positive territory. These are the considerations that the equity team have at present. As a reminder, we're very much a rigorous, fundamental, research-driven investment process. We believe you can find insights, you can find insights, stock-specific, idiosyncratic, where the mispricing is yet to be realized by the market. And when the efficiency is corrected, the value emerges. And that's a process that works really well at times, maybe less well at sometimes, but it's one that we believe over the long term gives us the best chance to deliver long-term outperformance. That being said, it would be ignorant of us not to at least consider some of the things that I've described today, which fall more into top-down and themes and so forth. It's healthy to be aware of what they are and what's going on there, because at sometimes, and especially through COVID and post-COVID, the market has been acting in more peculiar ways than it would be in usual times, lending itself less to the search for value that we're used to, especially over the 10 years that I've been doing it. This has been quite a difficult time. And finally, just in case I sounded a tiny bit bearish on New Zealand, and I certainly did not mean to be, I just wanted to be frank, honest, and open. I just remind us all about New Zealand's performance, the NZX 50 at least, over a number of timeframes going back 10 years. So these will be per annum, and how that's compared to international peers across the board. We've enjoyed a fantastic run, and my personal view is the economy will reopen. Consumer spending will go from a narrow, concentrated set of destinations and once again be spread across travel and dining and services and so forth. The sugar hit of the stimulus and the accommodative policy will play out, and then before long we'll be talking about the reverse. We'll be talking about the downsides of when the countries, even what New Zealand kind of tacitly implied this week, that QE will end, stimulus will end at some point, and the sugar hit will fade, and perhaps we go back to modest, slightly underwhelming growth with relatively low interest rates and structural threat of deflation hanging over us. And in that backdrop, New Zealand's strengths, which are persistent and very robust, they'll be back in vogue, before we know it, and we'll be performing really well again. So that's my view. Sorry for going a bit over time there. I probably tried to cover a little bit too much. I do apologize.
Thanks, Michael. Look, and you're right. There's a heap of interesting information there that's worthy of further exploration. But in the interest of time, we have run over, and so I thank everyone for joining us for this month's update. As always, we value your input, your feedback, and for your comments, and we look forward to seeing you next month. Take care. Cheers. Bye bye.
Thank you.